Well, joining me now with more is Talley Leger. He's a chief market strategist at the Wealth Consulting Group. Talley, great to have you on the show this morning, joining us from New Jersey. We like to see that. And stocks taking a breather. Of course, the president saying that we could see unilateral tariffs. What impact is that having?
So I would take a bit of a different read on the situation. I'm more of a glass half full kind of guy here, and the progress that we've been making on the trade front. Look, we've got 90-day reprieve for the global reciprocal tariffs, and we've also got another one with China. And it looks like I think the market is continuing to rally here amidst this improving investor risk appetite, Kristen.
Interesting. So certainly we do see the improving investor risk appetite to IPOs just yesterday here at the stock exchange. Talley, what other evidence do you see that the market is gathering steam?
So, as I say, in the near term, I think that improving tone to the sentiment surveys, whether it's CEOs, consumers, or investors, is really helping drive an ongoing rally. Looking beyond the near term, more strategically, look, the major kind of linchpin to the thesis here of buying into any potential weakness as opposed to selling into strength is the stability and health of the fundamentals. And I'm really talking about resilient corporate profits and economic activity right here.
Yeah, let's talk inflation, because the inflation data certainly this morning and yesterday did show seemingly that the economy in the previous month was on a solid footing. Talley, what data points are you looking at leading into that Fed decision next week?
So I think what the rather tame inflation reports we continue to see help achieve or accomplish is really kind of coax the Fed back into the game, off the sidelines, and get them, maybe not next week, but ultimately to continue along their gentle glide path of easing monetary policy. And it's interesting to see at the beginning of the year, we had almost no Fed rate cuts priced in amidst high economic optimism. That changed completely to over 100 basis points of cuts around the April lows in the stock market amidst high economic pessimism. And now we've settled into something more along the lines of 50 basis points of cuts by the end of the year. I think that's about right. You don't want to overdo it with the cuts, because that could signal to markets and investors something more sinister at work in the economy. And I just don't think that's the case right here.
Interesting. So in terms of how you're advising clients, Talley, what looks attractive to you now in building a portfolio in this environment?
Yeah, I mean, Kristen, we're getting a lot of questions about the sustainability of the rally. We think it continues. The sentiment and positioning pendulum has, I think, a long way to go before it becomes extremely ebullient, if you will. And to us, in the near term, that helps sustain the rally. And I think as a result, you really want to stick to the pro-economy or cyclical sectors of the market. To us, those have included and continue to be sectors like the industrials, the financials. Those are the older economy sectors of the market, as well as technology and consumer discretionary.
I do want to ask about the seasonality at play here. There is that old adage, sell in May and go away, but certainly we know this is a very dynamic environment, Talley, at the moment here. How are you managing seasonality trends here as we enter the summer?
Yeah, I mean, that's a great point. So we've been in the April showers bringing May flowers. That trade worked a little bit too well. So if we do get a period of consolidation to kind of digest that ferocious month of May, which was the best month of May since 1990, again, our strategy would be to buy on any volatility that crops up. And to your point, we're actually already on the leading edge of a pretty favorable seasonal period from June to August. So I think that continues to support the market here. September, at the tail end of the summer, you do historically see some volatility, and I'd be shopping the bargains if we do see some of those drawdowns.
Okay, I do want to ask about that because equity valuations at these levels, could perhaps be considered a little bit lofty. So a pullback might be a good entry point, Tally. But historically speaking, what do you make of those valuations right now?
Well, I mean, look, I think your point is well taken. The kind of growthy U.S. Tech stocks have been getting a little bit frothy here. That was the case heading into the year. That's not new information, but I think you do get what you pay for, and that is growth and quality. If you are looking for valuation opportunities, really some segments or cohorts of the market that haven't been keeping up. You feel like you missed the rally in the Magnificent Seven and the tech sector in the large cap space. Take a look at the mid cap realm. Historically, that cohort of the market is known for some pretty solid earnings growth, and the valuations right now are looking pretty attractive, Kristen.
Talley Leger, he's a chief market strategist at the Wealth Consulting Group. Tally, thank you so much.
My pleasure.